So welcome to another session of the CISI Level 2 Fundamentals of Financial Qualification content. We're actually up to session 10 now, and we are picking up with looking at benefits of share ownership, so benefits for shareholders, and we're going to focus particularly on financial returns. So that's going to be the focus of this week, picking up on issuing shares and IPOs that we looked at in the previous week when we were looking at Facebook and some other case studies of companies that had listed and gone public. So we're joined by another special guest today. I'd like to welcome Tristan Purcell, who's an equity research analyst at Fidelity. Hi, Tristan. Thanks for joining us.
Hi, and so I don't know, do you want me to give a quick introduction?
Yeah, please. Yeah, Tristan, if you could just tell us a bit about who you work for, what Fidelity does, what you do in your job role, and how you got to where you are in your career pathway. That'd be fantastic. Thank you.
Yeah, great. So I'm, as the slide says, I'm an equity research analyst, and what that means is I look at different businesses around the world and try and decide what they're worth and whether they're good investments. I work at Fidelity, which is an asset manager. There's lots of asset managers around, and what we do is manage other people's money in order to hopefully grow it or give them a return to provide for their pension, or if they're saving for something, or if they're an insurance company that has to pay claims in the future, things like that. So we invest other people's money to hopefully try and grow it. I got into this industry through a slightly different route. So I originally did GCSEs, then A-levels in maths, physics, and IT. Then I did a degree in maths and physics at Bath. And following that, I went into the military. I joined the Air Force, and I was a pilot for 4 years, then an air traffic controller for 5 years, including time in Afghanistan and various other things that aren't relevant to this. And then following that, I decided to come out of the military, and this is something I'd always been interested in. I'd always been interested in companies and stocks and shares and investing, and I managed to get this role at Fidelity, and I've been doing this for just coming up to 4 years. I think that's it.
Wow, thanks, Tristan. That's fascinating to hear the completely different pathway that you took from being in the Air Force and air traffic control to working in financial services. It's fantastic, and just goes to show again that you don't always carry on that linear pathway, that things often change, and even though you had an interest in financial services, it was kind of very different to what you were doing previously. Are there any similarities between being a pilot and working in financial services? Any kind of skills that you use that kind of transfer across quite nicely?
I think there's some. So I'd say both are fairly quantitative. They both require sort of a good grasp of maths. You're constantly, as a pilot or an air traffic controller, you're constantly sort of dealing with numbers, and you're under pressure trying to do things very quickly in your head quite a lot of the time, whilst doing lots of other things at the same time. And in my role now, I'm still doing quite a lot of number-heavy work every day, so that definitely comes across. I also think there's a certain amount of dealing with stressful situations that's quite useful. It's a very different type of stress. If you're controlling aircraft and you get it wrong, then that's a pretty big problem. Whereas what I do now, if you mess it up, then you just cost money and not lives. So it's slightly different. You've got more time to deal with it now, but there's still definitely pressure involved. So that's probably a similarity.
Yeah, absolutely. I can imagine. It's well, never worked as a pilot or air traffic controller, but I can imagine the pressure is quite intense, and I understand obviously that working in financial services there is that as well. In terms of it's all about money, so pressure. So absolutely, but a different type of pressure, and hopefully not quite so worrying if you get it wrong in financial services so much. So thank you very much. Really great to hear your career pathway and what you do currently. So Tristan will be here too. We're going to have some discussion around the content of this session, and Tristan's going to give his insight into some of the things we're going to talk about as well. So as I said, what we are going to look at in this session is the benefits, or are the benefits of shareholding, or holding shares, owning shares, and we're going to focus on the financial benefits of being a shareholder, or the potential financial benefits of being a shareholder. And so we're going to look at those, and we're also going to look at being able to calculate the dividend yield, which we will go into a bit more depth about as we get to that part of the session. So really a focus on financial returns for shareholders, looking at it from the shareholders' perspective, whereas in the previous session we looked at it from more from the company's perspective, and why they would look to go public and issue shares. So the first thing we're going to do is look at the pre-session task that I set you to have a look at in preparation for the session. And the task was to look at a website containing data, company data for Ftse 100 companies. Now, I'm going to ask Tristan, I'm going to put him on the spot here. Would you be able to explain to the students what the Ftse 100 is for us?
So the Ftse 100 is as long as I get it right, it's the 100 largest companies in the UK, or that are listed in the UK. So they may be based overseas, but they've chosen to sell their shares on the London market.
Brilliant. Thanks, Tristan. Yeah, so they're listed, as you say, the 100 largest listed companies on the London Stock Exchange. And I think that's a really important point that you make there as well, that the Ftse 100, those companies may not be UK companies, they can be international, overseas companies that are listed. And am I right in saying that normally the Ftse 250 is seen as the index which has a larger representation of UK companies? I believe that's the...
Yeah,
yeah.
Because the top 100 often, I mean, you've got things like Shell or Unilever, which operate all over the place. And then the 250 is the next 250 after the 100. So they're slightly smaller businesses and generally more UK based. But I think even then they're still probably 60% UK and 40% overseas, somewhere around that.
Great, thank you. I think London Stock Exchange is generally viewed as the kind of the most international exchange of the main stock exchanges around the world. If again, if my memory serves me correctly, I may be wrong on that, Tristan, but I believe that's... Yeah. Excellent, good. I'm not talking nonsense. Fantastic. Brilliant. Okay, so what I'm going to do is I'm going to take the slides down. I'm going to put the data up on the screen. So bear with me for one moment. And we shall share this here. Now, Tristan, can you see the data up there?
Not yet.
Okay. Let's try again.
There we go. Yep.
Fantastic. Okay, good stuff. So the first question really was asking, what does if you look at the screen here, we've got as it says here, dividend yields, Ftse 100, and then we've got the list of companies, the top 100 companies here that are listed on the London Stock Exchange. Now, we've got the company names, the prefix for the companies, and the sector that those companies exist within. So the sector is the type of business that it is. So whether it's financial services, banking, we've got tobacco, oil and gas, pharmaceuticals, different industry sectors that those companies would be classified as. But we've also got two sets of data here on the right-hand side of the screen. So you've got market capital, and you can see that's in millions of pounds sterling. And then we've got this annual yield, which is a percentage for each company. So again, I'm going to put Tristan on the spot here. If we focus on the first column here, which is market capital, what do we mean by market capital, Tristan? What's the meaning behind that term?
So market capital, or I guess market capitalization or market cap, I would describe that as it's the total value of the company. So if you were to go to all the different shareholders of Unilever and say, I'm going to buy all of your shares, then the total amount of money you would spend, but what it would cost you to buy the entire company is that figure there, 100 billion pounds.
Right. Okay, so we're talking about the total value of the shares in that particular company, aren't we? So
yeah,
if we were going to do a simple calculation, how would we work that figure out?
So every one of these companies will trade on the exchange, and they'll have a price per share or a share price, and there'll be a set number of shares that are being traded at the moment. And so if you multiply the share price by the total number of shares that are out there, then you should end up with that market cap figure.
Excellent. So that market capital or market capitalization figure, as it's also known, that changes on a daily basis. I suppose it could also change on almost a second by second basis as the share price generally changes. Is that right?
Yeah, possibly even faster. Yeah.
So the market capitalization figures are a moving feast. They're constantly changing all the time. But as Tristan said, that represents the total value of the company listed on the exchange in terms of its overall value of shares or total value of shares in that company. Fantastic, excellent, thank you. So you can see here we've got those figures. Now we can see which is the largest company in terms of market capitalization. I think it's probably already selected. Yes, it is. So a company that Tristan actually mentioned earlier, which is Unilever, which is I suppose it's got here personal care, drug and grocery. I suppose you could label them as a fast moving consumer goods company. I suppose might be the term to use to describe them. So Unilever they do produce food, I believe, don't they?
Yeah, I was going to say I know them more for food than for a lot of those things. Food and I don't know what else, toothpaste and shampoo and that sort of thing.
Yeah, kind of cosmetic kind of goods and things like that. I'm sure they make quite a lot of ice cream. I think quite a few ice cream products. I think.
Yeah, that sounds right.
Yeah, it sounds about right. Yeah, so Unilever, you probably have many Unilever products in your household that you probably don't know are produced by Unilever. So very, very big company. So you can see they are top number one in terms of the Ftse 100, in terms of the market capitalization or total value of the shares in the company there. So huge company in terms of the value there. And as you see as you go down, again, a company that you will have heard a lot about in the news, AstraZeneca, that are responsible for working with the Oxford Institute to produce the Oxford vaccine, the COVID-19 vaccine, which has caused some controversy in Europe over the last sort of month or so. Again, big pharmaceutical firm. You can see here HSBC, obviously a bank, is in there. Rio Tinto, which is a mining company. There's some huge companies that are sitting on the Ftse 100 in terms of and looking at the market capitalization there. BP, oil company, Royal Dutch Shell, GSK, GlaxoSmithKline. We've got British American Tobacco. You will notice that some of these companies are quite controversial. One of the things to kind of pick up is how many of these companies maybe exist in industries that may be frowned upon by certain investors or not, things that certain investors might want to invest in. Tristan, have you seen quite a lot of change in terms of maybe some of the companies that you're looking at as potential investments? Do you feel that investors are thinking more about kind of the green agenda, like ESG, environmental, social governance investing, socially responsible stuff?
Yeah, it's definitely changed. So as I said, I only started doing this 4 years ago. And at the time, I think we had 2 ESG analysts, and all of that aspect of the job was down to them for all of our companies. And it wasn't part of my job role at all. Whereas now I think we have a team of at least 10, and taking consideration of climate change and the way the companies are run for employees, their culture, their impact on the sort of the communities around them, all those sorts of things. That is now a core part of my job, and I have a separate rating. That's how we do it, specifically on ESG. So it's changed, and it's changed dramatically in a very short period of time.
Yeah, very interesting. Yeah, good to. Well, it's very positive in some respects, but even looking at this, some of the companies that you may look at that investors may be less keen to invest in on that front, things like maybe BP, Shell, things I'm thinking about, BAT, British American Tobacco. These are still massive companies in the FTSE 100, huge market capitalization. So they are still kind of at the forefront of of the companies that we see and come across. So I suppose we're kind of almost a fairly early stage with the whole ESG or socially responsible investing, but it's gathering momentum. It sounds like, Tristan.
Yeah, definitely. It's definitely moving forwards. Yeah.
Excellent. Okay, brilliant stuff. Thank you. And then we've got the other column of figures that we have there is titled annual yield. Tristan, what's that referring to?
So that would be, I expect it's the dividend yield. So dividends. I asked Matt, have the students covered bonds already, or is that later in the syllabus?
No, the bonds are slightly later. That's the next topic to come on to.
Okay. So dividend yields are, so it's the dividends you receive divided by the market capitalization. And what is a dividend? It is all of these companies. So say BP makes a whole load of profit every year. And of that profit, some of it they'll keep because they need to expand the business. They need to invest in new oil rigs or hopefully some wind farms or something a bit more ethical. So they need to retain some of those profits to reinvest in the business and grow it. And what's left, they will just give it back to shareholders. So if you are a shareholder in BP at the end of every year, you're going to get some actual cash back. So if you bought, I'm taking BP, if you bought £100 worth of shares in BP, at the moment, according to this table, you would get £6.16 back at the end of that year. And you would hope that over time, that £6.16 grew next year to maybe £6.80, the year after to £7.50, and so on as the company grows and reinvests that chunk of profits you don't get back. The dividend yield, the dividend should also grow.
And thanks for that, Tristan. Yeah, absolutely. So that figure there is talking about the dividends received by shareholders. So as you say, that share of the profits that they receive may be on an annual or semi-annual basis, whatever that might be. It's showing the percentage, which is the dividend as a proportion of the price of the share. Is that correct?
Yeah.
So that dividend yield is kind of showing almost a return on investment that the shareholder is receiving at that point in time. Would you say that's an accurate description?
Yeah, it's one of the components. So I'm guessing, I think we're coming to it, but you also get capital gains. But so it's the dividend yield is the actual cash you get back on a routine basis.
Yeah. Okay, excellent. Thank you. Brilliant. So thanks very much for that, Tristan, because you very nicely recap there. We've spoken about dividends previously. We'll look at that in a little bit more detail there, but it's really useful to hear again what a dividend actually is and what that means for shareholders. So we have this annual yield percentage figure for each company, which, as Tristan said, is basically the dividends divided by the market capitalization or the share price. And then what we've got up here is it shows the average dividend yield for the FTSE 100. So the FTSE 100 there it's saying that 3.11% is pretty much kind of the average yield for those 100 companies. So you can actually look at this table and look at how many companies have yields that are higher than the average or lower than the average. Now, one of the questions was to actually do that. And what I can tell you is that looking at this over the last couple of weeks, generally speaking, around 70% of the Ftse 100 have yields that are below the market average, and around 30% have yields that are higher than the average. So if we click on this, it shows us that the company in the Ftse 100 with the highest dividend yield is Imperial Tobacco. So what does that, so that means that the 10.02% return is the highest in terms of the dividend yield itself for shareholders. So if you were looking potentially at investing your money in shares, you may consider looking at the dividend yield and use that to compare with other investments. Do you use the dividend yield figure much in your research, Tristan?
Yeah, it's definitely an important component. But I guess there's also the risk that if a company like Imperial Brands, for example, with its 10% yield, there's also the question of, is that yield sustainable? So is it going to be 10% this year? Or if you put in £100, you might get £10 back this year. But in 5 years' time, are they still going to be able to pay £10 every year? Or is this a business that, like in the case of the tobacco companies, is under enormous pressure as people generally stopping smoking, or smoking is getting more highly regulated? Can they keep on paying £10 a year? Is that £10 going to become £5 in 5 or 10 years' time? So that risk.
You're looking at. Sorry.
Yeah, so that risk is something you have to account for, and that's probably why you sort of see the types of companies that are up the top there. If you can get 10% a year from Imperial Brands, or £10 a year from Imperial Brands, and they're going to be able to keep paying that forever, then that's a really good investment. That's a very good return by the standards that we work to. So I would imagine that the market in general doesn't believe that Imperial Brands can keep paying that same dividend year after year forever.
Thanks, Tristan. That's very, very interesting. So what's interesting to hear is that it's not just about what the dividend yield is now, it's that forecasting or predicting in the future, is that something that's sustainable? And if not, that might sway the decision of whether or not to invest in shares in that company. And what's really interesting there is a point that we'll probably come on to a bit later, is that investing in equities or shares is a much longer term, a longer game, if you like, than it might initially seem on the surface. So I think we see a lot, you see a lot in films and about the whole kind of, get rich quick and let's put our money into shares and quickly making money from that. But actually, the feeling I'm getting from you and from speaking to other people is that it's a long-term game. It's about being in it for the long term, holding on to those shares and seeing what happens. Would you say that's an accurate way of looking at it, or is it seen slightly differently?
No, it's absolutely that. You can, I guess there's different styles of investing. Some people will treat it like gambling effectively. You're going in for less than a year or so and just trying to hope that the shares swing around a lot and you can make a quick profit. But really what you're actually doing when you buy a share is you are buying a piece of this business. So if you buy Imperial Brands, you are taking an ownership stake in that tobacco company. And a business should grow over time and hopefully grow its profits over time. And you get a share of that return. So yeah, I mean, we think in sort of 5-year time horizons, we hope to realize a decent return over 5 years. That's kind of the ballpark, but the volatility is quite dramatic, and the actual performance of the business doesn't necessarily show or doesn't dominate the return that you get until you would start talking about 10 years or more. Any shorter horizon than that, you are very much exposed to swings in market sentiment and all sorts of other things.
Yeah, absolutely. Yeah. Okay. Yeah, it's really good to know as well. So is that kind of 5-year target, but actually you're looking even further than that. You're looking at kind of, the 10-year, which hopefully smooths out some of that volatility that that you might see. Okay, excellent. Right. So I'm hopefully that gives that was the pre-session task, just to kind of give you a bit of a feel about some of the data and the things that matter to shareholders potentially when they're looking to invest. So I'm going to remove that from the screen, and I'm going to bring the slides back up. Bear with me. Do love technology. Okay, here they come. Now, hopefully you can see those again. Does that come up on the screen now, Tristan?
Yep, slides back.
Fab, brilliant. Okay, fantastic. So some really good insight there from Tristan about market capitalization, dividends, dividend yields, and the considerations that that Tristan takes in his job when looking at doing the research that he does and recommending certain companies in terms of investing in shares, depending on what people are looking to do. So to kind of summarize that and some of the points that we've been speaking about, we just need to kind of consolidate the two ways that shareholders can make financial returns from shares, if you like. So we'll come on to the dividends piece after something else that we look at. And we're going to look at dividend yields in a bit more detail as well and how to calculate those. So based on some of the data that we saw there in the examples in the on the website, we're going to look at how you calculate those because that's something that you will be asked to do during the exam. So the other way of making a return from shares is something that Tristan has actually mentioned already, which is capital gains. Now, Tristan, you didn't go into any detail about that when we were talking about dividend yields, but can you explain to us what the first or one of the ways that shareholders can make a return through capital gains? What does that actually mean?
So I guess in the simplest term, it means that if you buy a share today for £1 and then tomorrow somebody offers you £2 for it and you sell it, then you've doubled your money. So there's no dividends have happened in that period. All you've done is managed to buy something that somebody else has wanted to buy for more a period of time later. But the way, and doing that in a very short time frame of less than 6 months or a year or something like that, is sort of more at the gambling end of what I was describing before. And the way we look at it is that, again, you're buying a stake in the business. So if a business makes, I don't know, say £100 million a year of profit, and it's decided to give £50 million of that back to the shareholders as a dividend, then you've got that money. And then the other 50 million is invested in developing new products or building a new factory or doing some marketing, and hopefully trying to grow the business so that next year, instead of making 100 million, they make 110 million, and the year later 120, and then maybe after 10 years they're making 200 million. And generally speaking, if a business is worth, so if it's making £100 million in the first year, then maybe it's worth £1 billion. That's what you'd expect to pay for a company making that amount of profit. So in other words, about 10 times its profits. So if your company after 10 years is making 200 million, then it's probably still worth 10 times that. So it's probably then worth £2 billion. So as well as all those dividends you've collected in that 10-year period, your business is worth twice what it was at the start, and therefore your share is worth twice what it was at the start. So it's exactly the same thing as your one share going from £1 to £2, but just spread over a very long period of time. And it's driven by the reinvestment in the business and growing that business rather than relying on fluctuations and random movements in the market and people going crazy in a very short period of time.
Yeah, so that's really interesting, actually, in terms of what you're saying about how shareholders get to that point where they make a profit on the shares. It's reliant on the company doing X, Y, and Z to get it to that point. So it's not, although you've got share prices are determined by supply and demand, if you like, or market forces in terms of what someone's willing to pay and what someone's willing to sell it for. Ultimately, the reason someone will want to pay a certain price for it is because of what the company is doing or will do in the future that will push that share price, or they think will push that share price up. So sometimes it's quite easy, I think, to think that the share price going up is kind of abstract from other things that are going on. But actually, to get to that point for the share price to go up, something needs to happen. The company needs to be doing something that encourages people to want to pay more for that share. And I think sometimes it's quite easy when we're looking at this and not working in the profession, the concept linking what the company is doing to the increase in share price. Sometimes we probably overlook that a little bit. So it's really good to hear that obviously things that are going on within the company obviously has the impact of raising that share price and creates potential profit for the shareholder. Excellent. Thanks, Tristan. So as Tristan said, ultimately the capital gains it's basically the equivalent of making a profit when you're selling shares that have increased in value from what you paid for them. So it's that difference from the moment you buy them, what you buy them for, and hopefully, obviously, the share price will go up over a period of time, and you can sell them for more than what you paid for them. And so this is what's known as a capital gain. So the increasing value of an asset. I mean, capital gains can also be can be used when referring to other types of assets, not just shares. So if you're selling something you own, say for example, property, if you own a second property that you don't live in and you sell that for more than what you purchased it for, you could be liable. You've made a capital gains, you could be liable to be taxed on that, just as you could be for profits that you make on the sale of shares. So that's what we would refer to as a capital gain. And just to kind of give you sort of technical terminology, I don't know if Tristan, you ever use these terms, or it's just something that kind of technical terms that or jargon that's in the workbooks. But if a capital gain, you cash in and you actually make that money, they are seen as being realised. But if you don't sell those shares and gain that profit from those shares, they are unrealised. Do you use those terms in what you do?
I guess not necessarily day to day, but it is definitely the terms that come up when you're looking into a company's accounts. So if they're a company that happens to invest in other things like buildings or other equities or bonds or whatever they might be buying, that's definitely the terms they would use: realised gains and unrealised gains to describe them every year.
Right, excellent, thank you, excellent stuff. So to pick up on one of the points that Tristan had made earlier is that obviously making a profit on the shares that you purchase is not always possible, that share prices are volatile. And Tristan spoke about holding on to shares for sort of 5 to 10 years before kind of realizing or smoothing out some of the volatility in those share prices. So just bear in mind that share prices are volatile. They go up and down constantly, depending on the buyers and sellers and what's going on with that company. So you just have to be aware of that. And it all comes back to risk and reward, which we spoke about quite early on in the course. And remember that generally speaking, equities or shares are seen as a riskier investment when compared with maybe safe investments like bonds or putting your money into a bank account or an ISA or something like that. So just be wary that price volatility means that capital gains may not be possible, and you're not guaranteed them as a as a shareholder. It's not something that you're definitely going to get. Oh, I'm going to sell those shares for more money. That's not guaranteed. And again, it comes back to that risk and reward. Higher risk, higher potential reward, but there's also a higher risk that you will lose. You potentially could lose your money or lose some of your money. So just bear that in mind. And picking up on the tax piece as well, as we said, if you sell shares and make a profit on them, you could be liable to pay what's known as capital gains tax. So any profit made there, if you are, depending on the type of taxpayer you are, which is dependent on how much you earn and what category or band you sit in. But if you're a basic rate taxpayer, you'll pay a 10% tax on the profits of those shares. And if you're a higher and additional rate taxpayer, you'll pay 20% tax on the profits made on those shares. So again, the tax man will get you by hook or by crook. So even on capital gains and making profits from shares, you could be liable for taxing. And just to kind of reiterate the point that we've spoken about, mentioned a few times here about investing in shares is a long game. So just bear that in mind again. Making kind of quick money from buying and selling shares, as Tristan said, is kind of almost more gambling than it is anything else. So just bear in mind that to be responsible and kind of do it in the right way, it's a longer term strategy that's required to do that. So that kind of summarizes capital gains and the fact that it's all about selling the shares for more than what they were purchased for. And as Tristan said, there are lots of factors that come into play in terms of whether those capital gains are possible for the shares in that, if you own shares in a particular company. Excellent, thank you. Right, so the second way of gaining financial returns as a shareholder is something that we've already touched upon, which is dividends. And as Tristan said, dividends are this kind of ongoing, hopefully for a shareholder, ongoing income that shareholders receive from the company, which is normally determined by the profitability of a company and what the directors and the board see as the kind of strategic way forward and how they want to use those profits. So hopefully after, as Tristan said, after the company has taken all the money it wants from those profits to reinvest, there then is a pot left that is paid to shareholders almost as a reward. Would you say, Tristan, is that the right way to describe it?
Yeah, sort of. I guess. Yeah, it's your share of the business's profits that year. Yeah, it's the money that you're willing to take out of the business rather than keep in it.
Yeah, sure, absolutely. So again, this amount is determined by the board of directors, and as we've got there, it's often paid, can be paid half yearly. We've got their quarterly, annually. In the companies that you look at, Tristan, how often generally do they pay dividends? Is it normally on a half yearly basis?
Most are half yearly, yeah, almost all.
Yeah. Okay. So twice a year, if the board decide that shareholders are lucky enough to receive dividends, they might get it every 6 months. And it can be normally expressed either as a percentage or monetary value. And as we said, the amount is kind of based on profits, sometimes expectations, and what some of the strategic priorities are of the board and what they plan to do going forward. But as something that we've kind of touched upon is that they're not always paid. So just like capital gains, there is a risk that companies may not pay dividends, or they might pay less than what shareholders might be hoping to receive. Tristan, have you seen any companies sort of revising dividends as a result of COVID and things like that? Have you seen, as you've been doing your research?
Absolutely, yeah. So I'd say, I'm not sure what the percentage is. I'm pulling a number out of thin air here, but I would guess that at least 50% of the companies, probably in the Ftse 100 or in the UK, have not paid dividends this year or substantially reduced them from where they were last year.
Right, interesting. Okay. Absolutely. So external, business performance is a key determinant of whether dividends are paid. So if the business is doing well financially, profits are good, then the shareholders will be hoping for a nice dividend, a nice fat dividend to either 6 months or at the end of the financial year. So again, if a company or external factors have led to a company not doing so well, as we currently find ourselves in the hopefully the end of a pandemic, but the impact on the economy, the global economy, has been huge. So again, as Tristan said, companies are either not paying dividends or they're paying much less than maybe they would have done normally. So just bear in mind that they're not always paid out to shareholders. So it's not guaranteed, just like capital gains. It's not always going to be the case. Do you find, Tristan, when you're looking at kind of, say, companies that aren't particularly well established, do they tend to pay less dividends to their shareholders than maybe the more mature companies that have been around a long time?
Yeah, so I think that's a really important point. It's the first point on that not always paid list. And you think of these as companies that perhaps aren't so big, or you might initially think they're companies that aren't so big because they're newer. But the likes of Facebook or Google, I mean, they still don't pay dividends. And that's largely because if you're still growing, then of the profits that you make, so of that £100 profit you made, you can probably find ways of reinvesting all of that £100 and growing faster rather than giving half of it back to shareholders. And if you're a shareholder in that company, you kind of know what you're getting yourself into, and you expect that, or you want them to reinvest that all of your share of the profits back into the business to grow it even quicker. And so you still have very, very big businesses that still don't pay dividends.
Interesting. Excellent. So just bear that in mind again, that dividends, and it comes back to that risk and reward that we were speaking about, that regular income you might receive from dividends, it's not guaranteed. So just bear that in mind. And the other thing, picking up on the tax side of things, again, the tax man will get you. If you receive dividends, you could be liable to pay income tax on those dividends. So dividends would be seen as being part of your income, if you like. So it would be classified in the same way as your salary would be. So dividends are taxable under income tax. And again, if you pay a certain rate of tax depending on how much you earn. If you are a basic rate taxpayer, you will pay 7.5% tax on the dividends you receive. And if you're a higher rate taxpayer, 32.5%. But this is after your personal allowance or your tax-free amount that you have every year. And I think the savings allowance, which is also still out there, it's after that's been taken into account. So just bear that in mind again, that dividends are taxable depending on how much you earn and what you've already earned in that year. So that kind of summarizes the other type of financial return that shareholders can receive. So we've got capital gains, that profit that you can make, and we've got the dividends which are paid out by the company to shareholders, as Tristan said, normally every 6 months, so every half year or half yearly. So we need to now come back to something that we were looking at in those figures on the dividend data website, which is the dividend yield. So we've already spoken a bit about what the dividend yield is, but what we need to be able to do is calculate what the dividend yield might be in the exam. So you will be given questions where it will give you a scenario and it will give you figures, and you will be required to calculate that dividend yield. But what I will say is that you're not given the calculation, so you need to know what the calculation actually is. So in terms of how you calculate that, we'll come to that in a moment, but just to touch upon what dividend yields are quite useful to do is one of the things we see a lot is that you can use dividend yield to potentially compare those returns to other investments that you could make. Now, Tristan, in your research, do you often do you ever compare dividend yields from companies with other investments, or?
Yeah, it's definitely a component. So in particular, bonds. So the US government and UK government, they issue bonds, and they're generally considered to be not risky at all. Like, you're very, very sure that you're going to get your money back with you're lending it to the US government or the UK government. And so we consider that return, which is equivalent to a dividend yield. It's the cash you're getting back for the money you put in. And we compare that to dividend yields on equities, or I'm trying to think of another way, but earnings yields. So it's the dividends plus the bit that you leave in the business, that yield. We compare that to bonds and try to work out whether the difference between the two makes it worth taking that extra risk to buy an equity. Because if you could lend your money to the US government and they give you 20% a year, or you could buy a business that's really volatile and might go bust, and they'll only give you 5% a year, then why would you bother? You just go and buy the bonds. So it's definitely relevant.
Right. So you use it to compare different financial instruments, one company's shares to maybe these bonds in US government bonds, or something like that. Okay, so that's interesting. So you do use that comparison to understand where the choice, or what might be the most financially prudent choice to make in terms of the investment being made. Okay, that's interesting. Yeah. So do you ever compare dividend yields company to company, or do you also look at that as well?
Yeah, definitely. That's one of the key parts, I guess, is I guess you have different styles of investing, but if you have a fund that is specifically looking for companies that pay dividends because maybe you're retired and you actually want the dividends to live on, to spend, rather than you're trying to actually grow your money to retire on later. If you actually need those dividends now, then you have income funds, which are specifically designed to invest in companies that pay you dividends and pay you large dividends. So then it becomes it's probably the most important part of the investment case.
Right. Okay. Excellent. Thank you. Right. So in terms of how you calculate, so we can see that having a dividend yield is really important to be able to compare different investments that potentially could be made. Now, how you calculate that is depends. Again, in the exam, you may be given different figures to do this. So as you can see on the screen there, we've got the calculation, which Tristan already actually mentioned how you calculate this. But there's two ways to do it. The first is if you take the left-hand side of the calculation that's on the screen with the blue text. If you are given the total dividends paid out by the company, so you're kind of looking at working it out on a company-wide basis, you would then divide that figure by the market capitalization, so the total value of the shares in that company. And as Tristan said previously, the way you'd work that out is you take the total number of shares times by the share price to give you the value of the market capitalization at that point in time. So that's one way of doing it. So total dividends divided by market capitalization. You might also be given the dividend per share, so how much is paid out for every share in terms of dividend, and the individual share price. So if you need to calculate it on a per share basis, you would take the dividend per share and divide that by the individual share price. Once you've done that part of the calculation, you times that by 100, and that gives you that dividend yield percentage. Now, doesn't matter which way round that you calculate that, you will get the same answer. Okay, so you should get the same percentage. So that's how you would calculate a dividend yield. So just be aware that it depends on the figures you're given in the question as to which way you would calculate it. Okay, so let's kind of just show a very quick. We'll go through this. Sorry, we've already mentioned this. We're just going to show you a quick example of how you'd calculate these. So we've got a company. We've got three companies up on the screen there. Abbott's Inc., Cyber Inc., and Xenia Inc. And it gives us the dividends per share paid in the last year, which is in dollars, and our share price, which is also in dollars. So from those figures, we have to calculate the dividend yield. Now, as you can see, we've got the figures on a per share basis. So we've got our dividends per share paid in the last year and our share price. So we've got the figures on a per share basis. So if you remember, we take our dividend per share and we would divide it by our share price. So you might want to calculate that now. So you might want to pause this video. And the answer that you should get is 2.51%. So we've got our dividends per share divided by our share price, times that by 100, gives us our 2.51%. In the second example with Cyber Inc., we've got $8.64 a share, and the share price, which is dividend per share, and we have a share price of $403. So again, pause the video, see if you can work that out. And the answer you should get is 2.14%. So that's our 8.64 dividend per share. Divide that by our share price, times it by 100, gives us our 2.14% dividend yield. And then finally, we have Xenia Inc., $12.24 dividends paid per share in the last year, and $702 is the share price, high share price there. So again, using those figures, if you want to pause the video now and then work that out. So the answer you should get is 1.74%. That's our $12.24 dividends per share divided by our share price of $702, 1.74. So again, as Tristan was saying, you might, if these were companies you were looking to invest in, you might compare the dividend yields for those companies, and also looking at some of the factors that Tristan had spoken about earlier. You know, are these sustainable? Is it something that can happen over a longer period of time, or are there other things that will prevent that from happening? So those are examples there. Now I've got other calculations for you to have a go at, so we will just go through those for you. So this example, we have Ftse plc has 38 million ordinary shares trading at £4.50 a share. The company pays out £3 million in dividends. What is the dividend yield? So the calculation is up there, as you can see. Again, make sure that you pick the right figures to use. So if you've got the total dividends, you would then potentially need to calculate the market capitalization and use those figures there. So again, pause the video and then we will unpause it and we will give you the answer. So in this case, we've got 3 million paid in dividends in total, and we need to, so we've got the total dividends. We need to then use the market capitalization. So we've got 38 million in shares, or 38 million shares, should I say, and the share price is £4.50. So that gives us 171 million. So we do our 3 million divided by 171 million, times that by 100. That gives us a dividend yield of 1.75%. Another example for you here, Zebra plc has issued 27 million ordinary shares trading at £2.18. The company paid out 4.75 million in dividends. What is the dividend yield? Again, pause the video and then work it out, and we will then give you the answer. So again, for this question, you should get a dividend yield of 8.07%. That's 4.75 million paid in dividends. Again, it's the total dividends for the company, so we need the market capitalization figure as well. So we have to work that out by multiplying our 27 million ordinary shares by the share price of £2.18, which gives us 58.86 million. So if we do that division calculation there, times that by 100, gives us 8.07. We've got a third example here. GOT plc's issued 18 million ordinary shares, trading at £4.61. Company paid out 6.8 million in dividends. What is the dividend yield? Again, pause the video and then work that out, and then you will get the answer when you unpause. So the answer you should get is 8.19%. That's 6.8 million paid in dividends. And again, we need our market capitalization figure. So work it out in the same way. 18 million shares times by £4.61, which is the share price. That gives us 82.98 million. So if you did a division, times that by 100, that gives us 8.19%. And then finally, the last example here is a piece of the action, aptly named business, issues 12 million ordinary shares trading at £5.80. Company paid out 900,000 dividends to shareholders. What's the dividend yield? Again, pause the video and then look at the answer once you've worked it out. The answer you should get is 1.29%. So here we would take the dividends of 900,000 or 0.9 million, divide that by the 12 million ordinary shares, and we should have 1.29%. Okay, so you've got a slightly different one there for you. Okay, excellent. So just to summarize then what we've spoken about. So we've covered off the financial returns that shareholders may receive from the shares that they own. And we've spoken about dividends. So we've spoken about the fact that these are hopefully regular half-yearly payments made to shareholders from the profits of the company. But remember that the dividend amount is not fixed. It can vary if you get paid them at all. So as Tristan mentioned, during COVID, during this period, we have an issue with companies that haven't been able to pay dividends to shareholders. The dividends are determined by the directors, and just bear in mind, as we said, that dividends are not always paid. And then we've also got capital gains, which we spoke about first of all, which is when the share price rises above what you paid for it, and therefore you can make a profit on those shares. But again, what you should bear in mind is that this isn't a guarantee, as a lot has to happen to get to that point, and it is a long-term investment. And as Tristan said, just to reiterate that point, that you're looking at kind of a 5 to 10 year time period in which to kind of make sure that the volatility, it smooths out the volatility in prices there. So just summarizes the two types of financial returns that you're going to need to know about, and you will be expected to calculate the dividend yield in the exam as well. Now, Tristan, is there anything else that you would like to add to that we haven't already mentioned or we've skipped over?
Yeah, there's one thing that occurred to me while we were going through this is the concept of Mr. Market. I don't know if you're familiar with it, Matt, but it's the idea that if you just bought a business next door, like your local hairdresser or the co-op or something like that, and you're sat at home every day, and then every evening somebody comes to your door and knocks on the door, and it's a guy called Mr. Market, and he offers you a price for your business. And some days he gives you a wildly high number, and some days he gives you a wildly low number. And he's basically a bit of a neurotic or manic depressive, and his mood swings all over the place every day. But every day he will come back and he will make you an offer for your business. And that's a bit like what shares are like that are listed publicly. You buy the business, you buy your local hairdresser or your co-op or whatever, and you aren't expecting him to sell it the next day. If you're buying a business, you expect to hold it for a very long time. If you're buying a local business, you probably don't get somebody coming and offering you money for your business every day. But if you buy a publicly listed business, then you should probably have the same mindset. You should probably think in very long periods of time, but you do have someone offering you a price for your share of it every day, or every second of every day, almost. So that's one thing. And then the other one was, I was going to say, a dividend yield. I guess the difference between equities and bonds is that a dividend you would hope grows over time, whereas a bond you get the same amount every year when you come on to doing them. So if you bought an equity or a share where the dividend is just the same every year and never went up, then you have basically got the equivalent of a bond, albeit the share price will swing around. Whereas if you buy a business that takes some of its profits, reinvests it, and grows the dividend over time, then while you may look at the chart, the table we showed at the start, and you have a dividend yield of 5%, and you may look at a bond and you have a yield of 5%, and you may think it's roughly the same, but that 5% in the equity can grow, whereas the 5% in the bond can't. But then, yeah, as we've described, if the company invests in products or buys a factory and gets it very wrong, then that dividend can disappear, as can your capital, because the value of the company has gone down. So those,
sorry, it's just, and that's really, again, it comes back to that risk and rewards, the risk and reward concept that comes up as a kind of regular theme. It's, you can take slightly higher risks and hopefully you'll get that higher return, or you could lose your money. It's kind of, it's making more a calculated risk, and based on what you know about the company, what you can see about their financial statements and the management and what's going on. And interesting. You're absolutely right. It's and that's, I keep saying on these slides, they won't always pay dividends. You won't always get capital gains. But actually, you're right. The other end of the spectrum is true, in which the dividends might completely surpass what the expectation actually was. So you can benefit hugely from that. I think we kind of sometimes from the outside you look at it and think, oh, we're going to buy shares, we're going to get dividends from it. So you kind of want to manage that expectation, but actually you're absolutely right. If you've selected the companies that you invest in well, and something happens, then potentially the dividends that are received by the shareholder could surpass any expectation that there actually was. So you're right, and you've got that opportunity for that dividend to grow. Whereas, as you say, when we look at bonds and we look at coupons received that are fixed, and therefore that can't grow any further, less risky, but there's no expansion in that. Again, it comes back to that risk and reward trade-off. Thank you so much, Tristan. We'll just the last thing to mention before we say goodbye. There's another multiple choice test on financial returns that you will find in the Google Classroom. So please do have a go at that and submit it. And there's also some pre-session work for the session that we'll have next week, where we will look at annual general meetings and some of the other benefits for shareholders and some of the risks that shareholders face as they own those shares. So that's everything for today's session. Tristan, it's been an absolute pleasure to have you with us. Thank you so much for your insight. It's been great to have you here. Really interesting to hear about your career story as well. And thank you so much for being here with us.
No, thank you, Matt. I hopefully get to do this in person eventually.
Absolutely. Definitely. Thanks so much, everyone. We'll see you at the next session.